guys, Kevin Bupp here. I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is multifamily syndicator Michael Blanc. Now, Michael's an entrepreneur who is passionate about helping people become financially free through real estate investing. He's the author of the Amazon bestseller, Financial Freedom with Real Estate Investing, and the host of the popular apartment building investing podcast. As the CEO of Nighthawk Equity, he controls over $200 million in performing multifamily assets all over the United States. And so, guys, it's been some time now since I've had Michael on the show, and so I'm excited to welcome back. So without further ado, I'd like to welcome back Michael Blanc. My friend, how you doing?
What's going on, Kevin?
Not much, man. Times are awesome. Times are crazy, but still awesome, right?
Absolutely.
It's been an interesting last. I guess we're going on a year and a half now of this craziness. We're recording this today. Just to give some additional context on August 24th, and so we're still in the heat of COVID. The pandemic still plays out, and it's been a couple of years since we've last spoken. Michael, obviously you've been running your real estate investing company through these, this last year and a half, these crazy times. And, as we look back and reflect, just like myself, I'm sure that you probably had some sleepless nights in March and April as we kind of rolled into the initial stages of the pandemic in 2020. And ultimately what we've come to find is that you and I both have chosen some amazing asset classes. You multifamily, some mobile home parks, and they have not just survived the pandemic, but in a lot of markets, they have thrived. And so excited to get caught back up with you, my friend. And so before we dig into the nitty gritty, maybe just for those that might not have heard of you, yet, they don't know who Michael Blanc is. I know you're a star, my friend, but there might be a few folks out there that still haven't learned about what you got going on and who you are. So give us a few moments of your time and tell us a little bit more about yourself, your background, and ultimately how you found your way into real estate.
Yeah. So, I have a background like a lot of other people, W-2 job. In my case, it was computers. I, studied computers and was a programmer, and in the late 90s got into a startup that went public, put a bunch of money in my pocket. Then I read Rich Dad, Poor Dad. And I was like, oh, I'm such an idiot. I need to find myself some financial freedom and passive income. So I quit my job because I had some money in the bank at the time. And I flipped the house. I traded some stocks and options, and I got into the restaurant business, which was my big bet into cash flow. So you have investing for cash flow. Mine would be restaurant investing for cash flow with Michael Blanc. What not to do. I subsequently lost everything in the giant restaurant debacle, very capital intensive. And it's not a cash flow business. It's a cash business. There's a difference. So, and I kind of clawed myself out with real estate. I flipped a couple houses and it was pretty good. So I decided to start flipping houses, which I did. We were buying 2 houses per month. And then I also got into an apartment building I got from one of my real estate wholesalers and got into that thing. That was my first syndication, but it was kind of like an afterthought. I had looked into apartments earlier in 2006, and I kind of put the whole real estate thing on hold for the restaurants. And I realized that the house flipping stuff is very active. It's a very active activity, while profitable, very active, not very passive, versus the apartment building, on the other hand, wasn't very exciting, but it was, it just kept sending me mailbox money. And I was like, I got to change this. I got to shift things up, and I got to do less of the house flipping and more of the multifamily. Mm-hmm. At the same time, also people were asking me how I did all this stuff, how I raised the money, how I found the building. So I was talking about this. I started blogging about it on the Bigger Pockets. And then people were like, well, how do I underwrite deals? So I created a syndicated deal analyzer and then created a course. And while this is going on, I'm blogging about this, people bringing me their deals. We did a bunch of deals with people who brought us their deals. We raised money, and today we own over $200 million in real estate. But more importantly, we've helped people buy, I don't know what the total count is, like almost 10,000 units over the last 4 years since we started doing this. And that's what really lights me up, because apartment buildings really is one of the fastest ways for people to get cash flow, but also create financial freedom for themselves. So that's what I'm excited to buy apartment buildings for myself, but I'm even more excited to teach other people how to do that.
No, that's awesome, my friend. I appreciate the background. And I know we've probably talked about this before. We've been on each other's show a few different times in the past. And I do believe your restaurant endeavors, were they pizza businesses?
That's right.
Okay. What exactly went wrong? And then we'll move on to real estate, because that's really what folks want to hear about today. But if you could, I'm sure you've gone back and you've dissected that business, the experience, and what went good, what went bad. What was it that really that really took the cake? I mean, as far as, what went the opposite way or what went wrong?
I'll tie it back to real estate. How about that? So what went wrong was the asset class was not sound, and it certainly was not recession proof like mobile home parks and multifamily. And that's really what happened. It was a very high-end gourmet pizza chain, very expensive, very good for you. I think still to this day, probably the best pizza on the market. But after the recession, no one wanted to pay $25 for a large pepperoni. They didn't want to pay $9.99. They wanted 3 toppings for free. And so therefore, the concept, the asset class, was not very recession proof at all. And I'd not considered the downside. I was happily signing personally guaranteed leases that my wife and I signed and no one's thinking about the downside. Everyone's like, well, let's get into what should I invest in? And everybody's thinking about the upside, how much money you can make, especially in an environment like right now. Like, we're printing money. What can possibly be wrong? And it was in 2005, we had a pretty big run up in real estate prices, and people were literally printing money. They could buy a house and 21 days later sell it for a $20,000 profit. Everybody was a genius. And so now, I look at the downside. I look at how does an asset class perform, not just in the last recession, but the one before that and before that. Every recession is a little bit different. And COVID obviously was quite a bit different. How do these asset classes perform? And this is why I like multifamily, mobile home parks, and self-storage. They perform really solidly in down markets. And of course, they go up in rising markets. But fundamentally, that's what went wrong, is it wasn't a recession-proof business.
Yeah, no, fair enough. I appreciate the additional context there. And just to give our listeners a sense of geography, where exactly are you investing in multifamily today? Where you guys spend most of your time? What markets?
So we're investing in the Southeast, but that's not the only place we can invest. There are a lot of markets in the United States that are great. And it's really where everybody's moving to is the South, the South and middle of the South, Phoenix are coming from San Francisco. There's a lot of markets that you can invest in that are growing in population. And then there's other areas that are declining in population, New York City, obviously, and Detroit, Chicago, some of the bigger cities. And people are discovering, my gosh, I can live much more affordably in a much nicer house in other parts of the country, right? So there's so many different places we can invest in, and there's many choices, which can be very confusing. What we've discovered is that, and you probably know this as well, is it's good to try to, in the beginning, you want to get to anywhere you can find a deal. It doesn't really matter as long as the area is growing. But after a while, when you're trying to scale, you really want economies of scale. I don't want to just 2 deals in a market or 1 deal. I want 5 to 10. I want 1,000 units in one market because I get economies of scale. It's easier to manage. The risk goes down. So we've actually been selling off some of our assets in other places that we've had in there. We're really in 3 areas right now. We're in Memphis, back from the old days. We probably accumulate 1,000 units back in the old days. I don't mind Memphis. We're just not really super active there. We have some stuff in Huntsville. Love Huntsville, but it's not a very big market, so it's not like I can do a deal every quarter. And then we have the chunk of our portfolio in Northern Atlanta, which we really like. And we're looking in the Carolinas only because we want to do 3 or 4 deals a year. So you have to look in areas that are big enough where you can sustain the kind of deal flow you're looking at.
Yeah, what part of the Carolinas? You talking about, like Raleigh, Durham area?
We don't have a deal there yet. I mean, it's tough to go wrong in the Carolinas right now.
I agree.
We'd like to use Charlotte as like the hub and have everything be like an hour and a half away from Charlotte, right? Same thing around Atlanta. We want everything co-located in Huntsville so that we can use the same proper manager. We might be able to share the same managers or regional managers so we get those economies of scale. It's tough if you're, let's say, in North Carolina, but you're 3 hours away. It makes the asset management a lot more challenging.
Talk to me about finding opportunity in today's competitive landscape. As we talked about, a few asset classes did very well during during the pandemic. Mobile home parks, multifamily, self-storage. Those are really the top 3 performers. A few others didn't do so well: hospitality, retail, office, what have you. And so lots of larger groups that were, had their equity tied up in office, retail, and self-storage, or not self-storage, but hospitality, started shifting a lot of their liquidity and distributing a lot more towards the multifamily space or the mobile home park space, thus creating a lot more competition. So, when a lot of us thought that cap rates might start creeping back up, and a little bit of, I guess, leniency on pricing when the pandemic started, the opposite occurred, at least in the multifamily and the mobile home park and self-storage space. And so with that being said, what exactly are you guys doing? I guess you could say over the last 12 to 18 months, what are you doing to uncover those opportunities given the competitive landscape?
I've heard this argument for a long time.
Mm-hmm.
Oh, and multifamily is hot. It's hard to find deals. Everything's hot, but it's been hot for like 5 years,
It's
honestly.
true.
I mean, there's nothing really changed. And so therefore
It
the
might be a little
solution,
hotter now, though, right? Just a little hotter.
yeah,
It might be a
yeah,
little
but the
hotter.
solution to that slightly hotter is still the same.
Yeah.
And the tactics are a little bit different maybe in your world than ours. I know you do some cold calling, which appears to work a lot less on the multifamily space. What really works well in the multifamily space is broker relationships.
Mm-hmm.
So broker relationships are absolutely key. When a listing hits the public market, you have multiple, it's basically almost like a public auction at that point. One is bidding higher than the next. You got multiple rounds of best and final. Not only are those hard to win, even for us, but also the price gets bid up. $56 million asking price. By the time the dust settles, it's $64 million. And you're like, oh my gosh. What's interesting about that, we've been studying this a little bit. These are not, mom and pop, unsophisticated buyers. These are sophisticated, almost institutional buyers. They're bidding up the price. Well, these guys aren't idiots. What are they seeing maybe that we're not? Why are they bidding up the price? Why do they think it's a good idea to pay $9 million more than asking price, right? So it's a fair question to ask about, well, what's in our looking glass moving forward? Can prices possibly continue going up? Are we in some kind of bubble? But typically in our environment, it's really investing in broker relationships, because what happens is, these guys are lazy. I mean, efficient, right? They want to get a listing from a seller. And what they would prefer to do is, if they have one or two buyers that they know are performers, they know they buy, and the seller's like, look, I need X amount of dollars out of this thing net. And I don't want any horse trading. I don't want retrading. I don't want to parade a bunch of people through. I don't want to be part of, 3 rounds of best and final. I want you to get me a solid buyer. Here's what I want. And this happens more often than you would imagine. And so we've gotten, of the last 4 or 5 deals that we've done, 3 of those have been in that way. They're either it's just us, or it's maybe one other bidder against it, right? One was completely off market. And that's when you study the deals that people are doing, that's the 80% of the deals are coming about that way. And it only results in the relationship that you build with brokers, meaning that you got to be responsive. You got to stay in touch with them, because no one, they're not as proactive as you might think. You can visit them every once in a while, actually hop on a plane and fly to the market, spend a day, take them to dinner, whatever, build rapport with these people. And that's really where the magic happens. And even in a best and final round, the relationship with your broker matters, because, for example, in the deal in Huntsville, we bid $600,000 less than a local group in Huntsville. But we had a very good relationship with the broker, and also the loan servicer had done a deal with us before. So it's all about relationships. We ended up winning the deal, not because of my normal good looks, Kevin, but because we had pre-existing relationships, right? And that's really the key. So everyone's asking this question right now. It's broker relationships. Invest your time in there, but then you get these semi-off market or off market deals. And that's kind of where the magic happens.
So if you actually had to lay out a simplified plan, you meant, jump on an airplane, go spend some time and take them to dinner. But if you just had like a simplified step-by-step plan for someone that's just getting started, what does that initial stage of building that relationship look like? And then ultimately, what's it look like ongoing? I mean, just if you could just from a higher level, simplify it and, give someone some direction as to what they need to do to get rolling here.
Yeah, the best way to find brokers is in LoopNet. LoopNet.com. You can create a free account. You can search. And typically, they say that that's where deals go to die, which is largely true, but it's mostly valuable for identifying who the brokers are. How many listings do they have? What kind of listings do they have? And then you basically create your target list. You create a spreadsheet of 10, 20 brokers, and you start calling on them, right? You call on them with with some education behind you, so you don't sound like an idiot. You've built a team, got a property manager behind you, a lender behind you, maybe an advisor of some sort, and you approach them from a position of confidence. That doesn't necessarily mean you have a decade worth of real estate experience, but you have some education. You're using maybe a script you prepared. And when you call them, you sound like you're a player. That's very simple. Whether you are or not doesn't really matter. But because of those things, and so these brokers then will take you seriously. And if they don't, here's what they say. They say, hey, that's great, Kevin. Why don't you send me your proof of funds and I'll send you some deals. And if they say this, that means you just sound like a newbie, which means you didn't follow the 2 things I just said. But let's just say you do and they send you deals. What's important next is that you're responsive, because most people don't respond to a deal at all, either because they're too busy or because it doesn't fit their profile. But in the beginning, you have to crack the deal open. You have to give them feedback. You have to say, hey, yep, this is in line. Let's talk more. Or like, this is not in line. It's too big. It's too small. There's not enough value add deal. The price is too high. You have to give them feedback.
Mm-hmm.
to do that. And then you have to stay in touch with them. The good ones do this, but not everyone is a good broker. So you have to stay in touch with them, maybe every couple of weeks, 3 weeks, and maybe send them a blog post or some kind of report and add value. And then you do have to meet with them. Once you've built rapport with them via email and phone calls, you do want to visit the market. At that point, you've established relationships with maybe 3 or 5 brokers, maybe 3 or 5 property managers, maybe a lender or 2. And so you go there for 2 days and you visit some properties, you build rapport, you try to select your best property manager. You're basically building your team in that local market. And you keep doing this over the course of time, and you will get the resulting off-market deals.
Yeah, no, I love that. And speaking to the other side of it, so when you guys are actually divesting of an asset, we're speaking to, to mostly off market. That's, you bought 3 out of the last 5 deals off market. They didn't go out for rounds of bid or what have you. They didn't go out to the mass marketplace. What do you guys do? How do you handle the other side of the equation when you're actually selling off assets? Do you put them out to the market, or do you allow them to be sold off market?
It's interesting. Even for us, we want kind of a simple process, right? Because we recognize that these best and finals are kind of a pain in the butt.
And they are.
And we do our internal calculations of, what is our target IRR. We've held the asset for a certain number of years, and to achieve a certain target IRR with our investors, we have to sell for blah dollars net, right? And so therefore, hey, do we have an off-market buyer maybe that might give us this thing very, very quickly? We know they can perform. So that's, we're selling one right now, and we think we have a solid buyer that's giving us what we're looking for. And therefore we don't need to go to market with it. But if this guy doesn't follow through, then we'll go to market. All right, then we'll go to market. So it's a lot more effort. I mean, clearly you're going to get the most out of it, but you also have a very high, commission. So it's always about the net. Right? People just don't pay attention. They look at the gross, but not really the net. So again, if we can preserve the net on something, but having a solid buyer that we know can perform, we'll do that every day. Others they have a different philosophy, right? I don't necessarily have to squeeze every possible dime out of a deal, because if I meet my projections pro forma, my investors are happy and I can build a solid portfolio with that. But there's nothing wrong with taking to the public market, especially in this kind of environment. There's nothing wrong with it at all. I'm not saying one thing is right or wrong. We try one thing. Can we get a quick sale? Great. If not, then we're going to go for maybe a longer process, and that's fine as well.
That's it. Yeah. No, and we've done both. And I think you hit the nail on the head there with that last sentence was, are we going to go with off market, or are we going to go with a longer process? And that, I think that's what folks have to realize, is that the actual, putting that property out as a listing and having the brokerage do what they do, right? Put together a nice, pretty marketing package and take their time marketing this asset to the, to the masses. It takes a lot of time. I mean, you end up finding yourself in a scenario where from beginning to end, it could be 4 or 5 months, possibly even longer than that. Right. And ultimately, if you've got a dedicated buyer or 2 that they know the market, they like your asset, it could essentially be, 2 months, 2.5 months, maybe 3 months at most, right? So a lot of times it could be half the period of time to get that unit or that project sold. So do you have any recent deals? Maybe it's the one that you're speaking to that you guys are actually divesting out of. We can better understand your business model. What you paid for the property, how much did you put into each unit? Like, what was the actual business plan associated with that property? And ultimately, what are you hoping to achieve on the backside? Just so we can, again, have a look underneath the hood as to what exactly the business model is.
So I don't have the exact numbers in my head.
That's fine. Just round numbers.
In general, right? The business model that I love more than anything else is the model where you're buying something that's a value add deal. There's clearly some kind of problem with, and you probably see the same thing in the mobile home parks, but there's some problem that you can fix because you fixed it before, because you're a better entrepreneur, a better manager, whatever, some kind of problem. And it's normally a combination of a lack of renovation and poor management. So, there's one deal we bought, 321 units in Memphis that had a combination of both of those. The rents were probably under market by $75 just because they weren't pushing rents. Now, why are they not pushing rents? I don't know. They've had the asset for 20 years. Maybe it was paid off. It was printing money anyway. Why are they not pushing it, right? Why are they not making this one look like the one across the street that's getting $300 more in rent? Like, why would you not do that? And the other question is, why would someone sell an apartment building where this is not done? We bought another one where only 10% of the units were renovated. They renovated the entire outside and then 10% of the inside. And they were getting the target rents that we were projecting, which is great because it's a self-comping rent. Now, why would they sell that? Why not finish the job? I don't know. I can't answer the question.
Yeah.
I don't know. I mean, I look at it internally, and again, you're looking at, and their business model may have been short-term holds. Maybe they make their money on construction and the equity buildup. It could be something like that. I've observed that if you want to sell something, you want to keep some kind of meat on the bone for the next person. I mean, not always, but it helps. You know, some kind of, maybe not everybody wants to do a heavy lift. Some people say, I just want cash flow and I want stability and predictability. But, you know, at the end of the day, you are serving investors and they do drive a lot of your decisions. So you can't hold on to the thing for 10 years. You need some kind of liquidity event. So back to our business case is really we want to buy something and add a tremendous amount of value in say 18 to 24 months, which is typically a combination of renovating the outside, making it look nicer, maybe adding an amenity or two, and then turning the units and making them look like the A player in that market, your A comp, right? Your one and two number one comps. You want to look like them because you've studied them. They're in the same market. They attract the same demographic, but they just are nicer and their rents are $200-$300 higher. We can do that in 18 to 24 months. We create a lot of value and then we can refinance. If we can do that correctly, we can return the majority of our investor capital back before those 5 years, let's say after 3 years or so. And now if I can return 80% of the investor's capital back, they're happy, right? Mm-hmm. They're not going to insist in year 5, oh, you should probably sell it because you told me you would give me my money back. Well, no, you got 80% back. All your risk is already off the table. You can then reinvest that. You're still getting cash flow on the asset. You can then reinvest the money you got back into another asset. So now you're getting double return on your money and they're happy as can be. And now I can, if I like the asset, I can hold it for the long term. I mean, ideally, I don't want to ever have to sell anything. And then I could refinance every 5 years. If I've smartly maintained the asset and I can refinance, I can keep pulling cash out and holding it for the long term. But the business model really is value add, ideally refi after 3 years and hold for at least another 5 years. That is a win-win for everybody.
Got it. And so going in, the type of debt that you use, are you typically putting bridge debt in place or maybe using a community bank to do the initial debt to get you to the permanent piece, or how does that normally work?
This is a mistake that we made early on when we were buying stuff and interest rates were at historical lows at 4 3/4, right? And we locked it in. We locked it in for 10 to 12 years. We're like, this is fantastic. And it was. The only problem we didn't think about is, well, the market would continue to go up. And so the valuations would go up. And we're like, oh, crap, we might want to sell this thing or we might want to refinance this thing. And then we discovered, of course, that fixed debt, you can't do that. There has these prepayment penalties.
And they're big prepayment penalties.
Yield maintenance penalties that no one understands. But these penalties are so big early on that they are not conducive to selling. So we started using bridge debt by requirement, especially if they're a heavier value add deal anyway. Mm-hmm. But then during COVID, bridge went away entirely for like 9 months. Mm-hmm. It was like poof, gone. So we used fixed floating rate debt, government-backed floating rate debt. And Brian Burke mentioned this for the first time like 18 months ago. I'm like, what? You're using floating rate debt? What are you, an idiot? And Brian Burke, of course, is no idiot. Yeah, he owns a lot more units and has been doing this a lot longer than us. So, it's like, okay, he's not an idiot. Why is he doing it, right? And he's doing it for the exact same reason that gives him flexible exit strategies. And so you got to make sure that you put the debt on that makes sense for your business plan. If it's a 5-year buy and hold, okay, then your prepayment penalty in year 5 is going to be fairly reasonable. Well, then lock it in and, rip the knob off for all I care. Yeah. But if you're going to do a refinance after 2 or 3 years, well, you can't do that. You have to use one of these floating rate debts. Well, the secret is that you can actually buy a interest rate cap. Might cost $30,000, $50,000. You bake it into your underwriting, and now it can float around at 3.5%, 3.25% now, but it can float up to a certain rate. Let's say it's 4.5%. And now I do my underwriting at 4.5%. And if the underwriting still works, now it's all gravy because my loan is actually 3.5% or even lower right now. But I can let it float all the way up to 4.5%, and I'm totally fine. So making sure that you have the right. The other mistake we made is that some of the early bridge loans were too short term. They're like 18 months. They're like basically a hard money loan. We're like, crap. Then of course you can't implement the business plan fast enough, and now you have to buy an extension on it. And one time we had a bridge loan that we had to refinance into a bridge loan because there was a shooting on the property. So we're gonna go from bridge to Fannie or Freddie government-backed things, and then there was a shooting on the property. And now, of course, no one will touch you with a 10-foot pole. So we had to refinance into another bridge product. Now, luckily, the property was making amazing cash flow, and we had created so much that didn't really matter. But we would have done so much better had we had more terms on that bridge debt. So now we have, 3-year bridge debt with, 12-month extensions to give us a total 5 if we need it. Because what happens if we want to refinance in 2-3 years and then there's some kind of market correction and I can't get it? Now I'm kind of screwed, right? So got to pay attention to the debt.
The debt is one of the most important pieces of the puzzle. It really is. And I think that a lot of folks, when they get into larger commercial deals, again, whether it's multifamily or any other type of larger commercial deals, they probably make a lot of similar mistakes that you've made, that I've made, right? Putting the wrong type of debt, not really looking too long of a picture, and limiting yourself on options as far as doing refinances or even potentially selling. We always, most investors, when they get started in real estate investing, they say, I want to buy and I want to hold forever, right? Like, and that still can be part of the plan, right? There are certain assets that we own today that more than likely, and I say more than likely, because there still is a chance that we might sell them, right? I mean, things happen, things change, life changes. And, but ultimately there's a few assets we have that I'll probably keep for more than 10 years. But there's other assets that I have purchased over the years that, if you'd asked me from day one, how long do you intend to keep this? More than 10 years, and ultimately sold after the 3-year mark for X, Y, and Z reason. And so you got to make sure that you're not limiting yourself and restricting yourself with the type of debt that you're putting on the front end. Because that Fannie Mae debt, that agency debt, man, it's sexy, right? It's sexy when you look at the 10-year fixed or 12-year fixed, 30-year amortization, phenomenal rates. But the defeasance is not very sexy at all. So it's lots of different pieces of that puzzle that you got to be able to fit together accordingly. I want to talk about the construction side. So we talk about like being able to execute on this business plan. And you made a couple points regarding the debt, and not having a large enough window to accomplish some of your business plans in the past on these deals. On the construction component, is it typically the property management company that's managing that construction project, or is it someone internally on your team?
Right. So it was a progression for us. I would say early on for us, as well as almost everybody, the proper manager will handle most or all of the renovation, right? They will bring the contractors in. They typically have a network of contractors and they do a bunch of stuff. And that works provided that your property manager has a capacity and a capability to do that. So we found that not all property managers are created equal. Some have the capabilities. Some even have an internal construction person or project manager, and some are more geared towards that than others. It's just like any property manager. You have to make sure there's a fit. For example, if I'm buying student housing, I'm going to use a property manager that knows student housing. It's considerably different, for example, for Section 8 housing. Totally different ballgame. Same building, but the management is totally different. So if I'm doing a heavier value add deal, I want a property manager that has done that before and has the capability to do that. Now, as you scale, however, this becomes more challenging, even for the property manager. So we, about a year ago, brought in basically a full-time construction manager, because when you're doing 5 simultaneous value add deals and you want to turn 10 units per month on a single property, it's a pretty good, but doing it times 5, now you're turning 50 units. Imagine flipping 50 houses every month, like, right? It's a lot. So the level of complexity is vastly different than doing a single value add on a single deal. And so we brought that in house, and it wasn't because we had the great foresight necessarily. We're like falling all over ourselves. Like, dude, we're not turning units. Why are we not turning units? Oh, well, this, that, and the other thing. And obviously the complexity was so high that it just wasn't getting done. And of course the problem is, if you can't turn units, you can't put tenants in there. And if you can't put tenants in there, you're not meeting your income projections, and therefore you're not meeting your pro forma. So it's a real big problem. And I think there's a lot of syndicators that downplay the importance of construction. I mean, right now, the way I look at it is, I feel like we're a bit of a construction company right now. It's the level of magnitude. I mean, when you're paying someone 6 figures to manage construction, it's a big deal. We kind of underappreciated and underestimated the scope of work for that. And you kind of solve problems. What I'd like to do is not solve problems. I'd like to be able to be proactive, right? So, well, what are others doing? Maybe they're a little bigger. How did they hire? When did they hire? Why did they hire? Right? So try to be more proactive. So we're fixing those things. We're trying to look ahead more than we did, say, 18 months ago, when we're like, oh, we have a problem. Oh my gosh, it's going to take us 6 months to fix this problem. So construction is a major part of our business. And the same thing is asset management in general. I mean, asset management, we thought was, one of those things where we, look at the reports from the property manager. We have a weekly call and, we kind of direct things here and there, but we discovered that professional asset managers are actually very hands-on. They literally go to the property every single month. They're almost part of the property management team. They're almost side by side. And we've discovered issues that the property manager should have discovered and they didn't, like major issues, there's a major boiler chiller that's been down now for 21 days and people are moving out. Why did no one tell us this? Why we have to discover that? Major problem. So in other words, no one cares as much about the asset as you do.
Yeah, I like to call a good asset manager. They're basically a forensic property manager, is what they are. They're there to help discover and uncover the problems that are probably lurking, that ultimately that are in place that the property management company might not be intentionally hiding, but they might not have brought to your attention quick enough. It might be months and months before it comes to your attention. Ultimately, costs you tens of thousands of dollars. So. No, that's great. I appreciate that. And one last question about the construction management side of things is, so with your in-house construction project manager, are they essentially working through the property management company, or are they basically direct to the GC working on the project? How does that flow work?
Yeah, so they manage a GC. They manage a GC, and depending on the situation, they may also be managing the subs. Even if this is the thing we discovered, it's like, the trust but verify is a very, very real thing. In other words, we've gotten to the point now where we want to know all of the subcontractor relationships. Like we want to know who the subs are. We want to know who owns them. We want to have a direct dialogue with them. It's just like, well, trust but verify. Same with the property manager. Anyone they use, we want to know who the heck they are. It's really about knowing what's going on and sometimes doing an audit on those people. So this construction manager manages the GC, and depending on the situation, that GC then manages the subs, with us knowing who they are. Or sometimes we may have someone who's a GC and let's say they take care of the exterior or just a roof or the parking lot. And then there's another crew that takes care of the interior, and maybe so there might be multiple contractors that we're managing. We have not yet found someone who can do it all. So it's typically on a typical deal, we're personally managing probably 2-3 sub general contractors for a particular deal.
Got it. No, appreciate that. And I'm going to pivot a little bit here. And, most folks only ever hear us talk about, you and us and but a lot of other syndicators talk about the deals that actually made it to the closing table, right? Like deals that you actually closed on and you're moving forward with. But a lot of times there's other deals behind the scenes that never, they're the unspoken deals. Maybe you got them in contract and you walked away for a particular reason, or maybe you got it, deep into the underwriting and uncovered some challenges or problems, or just for whatever reason decided not to move forward with that opportunity. And so share with us maybe a deal, in the past that ultimately, again, either you got tied up or got close to tying up, and then for one reason or the other, decided to walk away from it. And, let us know what that reason was.
This is a numbers game. Like house flippers understand this, but for some reason, once we get into commercial real estate, people are like, oh, I made a couple of offers and I didn't get anything. So obviously this thing doesn't work. Right? It's a numbers game. And it's almost like, oh my gosh, we're paying ourselves a 2-3% acquisition fee. Is that right? Is that reasonable? If you divide the acquisition fee by the number of hours it takes to get a deal over the finish line, you're working for like minimum wage. Yeah. Honestly, because the vast majority of deals are exactly the way you described. They never make it to the closing table at various different points in the process. And it varies. I mean, it could be that you lose a deal in the best and final. Or you're outbid, or maybe you even get it under contract and you get there and you discover something you don't like about the deal, which is awful. Then you have to get out of the contract and it's emotionally draining, but typically you're spending a lot of time analyzing deals, making offers, and, the broker dies laughing on the other end, right? It's a lot of that going on. Probably the most egregious one, this is a great story. This happened a little while ago, so I'm no longer emotionally traumatized by it, but we probably lost, over 6 figures in the deal. And it was a 561 unit deal that we did. And it was in Texas at the time. And it was too big for us. It was too big, but we were like, we can do this. We'll bring in a few partners, maybe some private equity, and we're going to crush it, right? We're going to get this deal done. Well, the deal was too big and they had some hair on it. It was a loan assumption. Or something other. And so our partners were like, yeah, this, that, and the other thing. They don't like that. And so the partners weren't very eager about the deal either. then we're like, okay, we're going to private equity. Now, of course, we've never done private equity before. And now I know in hindsight that doing private equity, getting into the private equity space or family office space is a multi-year process that starts, small and you build relationships with everything. So we found this private equity company, and they were very interested in us and really liked us, and they liked the deal. And then of course at the 11th hour, they decided that the deal no longer works for them for whatever freaking reason I know. Meanwhile, we're extending, the contract for $50,000 every time we extended it. So we're into this deal. And at the 11th hour, the deal, of course, falls apart, and we're like left holding the bag.
Oh boy.
So
wow.
Not only did that one not go over the finish line, I mean, we worked that deal for like 9 months. It consumed my partner's full time. That was his full-time job for 9 months, is making that deal work. And so his time was gone. Our emotion is drained, and a bunch of money. I would rather buy a Ferrari with the money that we lost. And so that's probably an extreme example. I mean, it's an extreme example where I think ego got the best of us. Typically what happens is you get something under contract maybe, and you discover there's something in due diligence you don't like, or you discover, you can't raise the money before your EMD goes hard, and you kind of, you're able to get out of the deal. That was basically a complete cluster.
Wow. Very interesting. So looking back on that, again, many different things kind of went wrong there. What would you have done differently? I mean, let's make the assumption that now today that deal is not too big for your group. I mean, that deal is a perfect fit for your group. What would you have done differently?
Well, that depends. If it were a perfect fit for a group, then we would have the capital raising capacity to do it. So now we are very dialed into our ability to raise capital. We kind of have a sense for how much can we raise? How long has the last raise been? Was it yesterday? Was it 3 months ago? Was it 6 months ago? What can we reasonably raise? What kind of partners do we have lined up that we've already been building relationships with that we can call on, right? Because if you need someone to come in with money and it's the first time you call them, well, it's going to take a while. And even if it were to go to fruition, it may not work out very well because you don't know each other very well, right? So, if you need something, you got to start building relationships right now. And so that's really the key, is being more realistic about your ability to raise capital, being proactive with money partners you bring on. Private equity was a long shot. I've talked to a lot of people who've tried this, mostly unsuccessfully. It's just a long game that you got to play. And again, it's all about relationships, and that may take several years. And the other advice on private equity is never take private equity money that you can't otherwise raise if you had to. So in other words, if I can raise $10 million, maybe I'll take $5 million, but if that doesn't fall through, I can raise the $5 million yourself. Now that gets you in the game. If you get the $5 million, now you're in the private equity space, but in the in a probability that you can't get that money, you can now make up for it. And so those are a variety of mistakes that we had made. We weren't realistic about our capital raise. We didn't have partners lined up before them. And we try to get in the private equity space on a live deal. Like, don't do that.
Yeah, no, that's great feedback. That's great feedback. And so we have not gone down the private equity road either. We haven't necessarily had to. We haven't had any issues with the capital raises that we've done, and also I've heard some horror stories as well, right? I mean, I guess it's kind of give and take. If you need someone to stroke you a $100 million check right out of the gate, it's going to be ultimately a lot less brain damage, more than likely, to get it from one source.
That's the
versus
thinking.
150 sources, but it's also a lot more restrictive money, right? It's a very different relationship than that of working with high net worth LPs. And so and another part, just kind of expanding on this conversation a little bit, as we go into capital raising on any given deal, I think what a lot of new syndicators don't realize is how much actual work goes in on the capital raising side. I think the capital raising side really is the unspoken heroes of deals. I mean, because there's just the amount of conversations and the amount of communication that has to take place, during any individual raise, it's significant. And so are you handling that, Michael, yourself, or do you have an investor relations person on your team?
Yeah. So the team consists of 3 partners, myself, and then Drew Niffen is the president. He kind of runs operations and everything. And then Garrett Lynch is a third partner, and he handles acquisitions plus a whole bunch of other stuff. Okay. But then we have a full-time asset manager, a full-time construction manager, a full-time investor relations person. And so that person then, answers the phones when someone schedules a call with us. They want to invest with us. There's a process for that. They answer questions. or if during an investment, someone has a question on their K1 or whatever, they kind of deal with that. They also then handle the live capital raise campaign, doing a live webinar and then getting people to sign their documents and getting the wires. And so they do all that kind of stuff. It really, I mean, if you're raising, any amount of money, it is close to, or if not a full-time job to do all those things. And it's both a customer service role, but it's also a sales role as well, right? Because if someone coming in and you want to try to get them into a deal, so it's a kind of a difficult role to fill with a single person. Sometimes you're looking for a special person. All of these people are highly compensated. You're not getting these people for $25-$30 an hour, right? You're paying real money. And in the beginning, this is really hard because you can hire someone part-time, but what do you really get if you get that part-time? How do you do that, right? So we've been trying to, we use our asset management fees to fund these operations. And our goal has always been to have the asset management fees equal to or exceed the expenses, but you can't always do that, right? Yeah. When you're bringing on a six-figure person and your asset management fees cover $60,000 per year, that person, you're like, I need this person. How am I going to get the other 40,000? Well, you know what? We're just going to start using acquisition fees. And you basically almost make a loan into the organization. You say, okay, the partners are going to pony up the $40,000. And then hopefully in one or two deals, the asset management fees will now cover that person. Okay, so now we're in the black again. Maybe we pay ourselves back or maybe we don't. But the point is now we're operating in the black. And then the same thing happens again at the next level. You go in these plateau and these tiers. I don't like the idea of using acquisition fees to fund your operations. There's obviously some disagreement about that. The reason I don't like it is because if you're forced to do deals, I know some syndicators who do this and they're very successful, but if you're not doing 3 deals in a year, you can't make payroll. And I don't like that because I think it forces you into making possibly, and we went 9 months in COVID without doing a deal. It was painful all around, right? And so had we relied on acquisition fees, it would have been bad for us. So I'd like to find a balance.
Yeah. No. I smile over here. For those that are just listening, you can't see, but I smile because we went through the same ebbs and flows. I mean, as we grow organizations. So you basically, you fund it, through the asset management fees and the acquisition fees and any other source of revenue that you have, you hire that talent that you absolutely need because there's you hit those different plateaus very quickly as far as the growth stage. You need to bring those experienced folks into the realm. You're looking for an asset manager for a $100 million or $200 million apartment portfolio. You're not going to go pay somebody $50,000 a year, right? You get what you pay for. You're going to be paying probably triple that amount of money to find someone that's quality and that's good and that's going to bring you the experience level that's necessary to help take your organization to that next level. So it's all fun. It's all fun. A part of the fun entrepreneurial journey, my friend. You know it. I know it. We've been there many different times, many different endeavors, and many different business types. So this is what makes us entrepreneurs, right?
That's right.
Well, good deal. Well, Michael, it's been a lot of fun having you, my friend. What is the best place for folks that want to learn more about you and your organization to get in touch with you, to I know you have a lot of different free resources out there. You've got your podcast. Is there one set place that they can go to?
Yeah, the website is themichaelblank. That's BLANK.com. That's where we have all of our pointers to our podcast and our book and our all our free resources as well. The best possible introduction to the world of syndication multifamily is probably my book. It's called Financial Freedom with Real Estate. And that is, by the way, also the new name of our podcast. It's now called the same exact thing, Financial Freedom with Real Estate. And so those are probably 2 fantastic entry points to learn more about me and also about multifamily and syndications in general.
Awesome. Great deal, Michael. Well, again, thanks for joining us again and look forward to staying in touch with you, my friend.